For decades, traditional retirement plans like 401ks and pensions were considered the backbone of financial security in the United States. Millions of Americans relied on these plans to save for their future, trusting that contributions, employer matches, and compounded growth would provide a stable income during retirement. However, in recent years, a growing number of investors are rethinking this approach and seeking alternative strategies to secure their financial future. One of the main reasons investors are abandoning traditional retirement plans is low returns. Many 401ks are heavily invested in standard mutual funds, which have historically delivered moderate returns at best. In today's low interest rate environment, these returns may not keep pace with inflation, reducing the actual purchasing power of retirement savings over time. Another factor is limited control. Traditional retirement plans often restrict investment options to a set of employer-selected funds. Investors looking for greater flexibility, diversification, and the ability to react to market changes are finding these restrictions frustrating. The desire for autonomy over investment decisions is pushing many towards self-directed accounts or alternative assets. Fees and administrative costs are also a significant concern. Many retirement plans charge management fees, fund expense ratios, and other hidden costs that can erode returns over time. For savvy investors, the cumulative effect of these fees over decades can be substantial, prompting them to explore lower-cost investment alternatives. Some investors are also turning away from traditional retirement plans due to concerns about market volatility and retirement security. Economic recessions, market crashes, and unforeseen financial crises have highlighted the risks associated with relying solely on conventional plans. Diversifying into alternative investments like real estate, stocks outside employer plans, and even cryptocurrencies is becoming increasingly popular. The rise of digital investment platforms and robo-advisors has made alternative approaches more accessible. Investors can now manage diversified portfolios independently, often at a fraction of the cost of traditional retirement plans. This democratization of investment tools allows individuals to pursue tailored strategies that align with their risk tolerance and long-term goals. Additionally, younger generations are redefining retirement planning itself. Millennials and Gen Z are more likely to prioritize financial independence and early retirement. Achieving these goals often requires investing outside traditional retirement plans. Using taxable brokerage accounts, real estate, and entrepreneurial ventures to grow wealth faster. Changing tax laws and regulations also influence investor behavior. Some traditional retirement plans may not offer the most tax-efficient strategies for high-income earners. This prompts them to consider IRAs, Roth IRAs, and other investment vehicles that provide more flexibility in managing taxable income during retirement. Concerns about the stability of employer-sponsored pensions and the solvency of certain retirement funds also play a role. Healthcare costs are another driving factor. Traditional retirement plans often do not account for rising medical expenses, long-term care, or unexpected health crises. Investors increasingly recognize that they need a flexible financial strategy. In conclusion, while traditional retirement plans still serve many Americans well, a growing number of investors are seeking more control, higher returns, diversification, and flexibility in preparing for retirement. Alternative strategies, technological innovations, and shifting financial priorities are driving this change.